Good evening. Today is the 15th of November, 2022. It is clear now that the late day sell-off seen yesterday was triggered by consumer fears and the upcoming onslaught of retail earnings this week. This is evidenced by the massive 2% pre-market rally after the release of Walmart's better-than-expected third quarter earnings report, beating both top and bottom line estimates. In addition, the largest U.S. retailer raised its full-year net sales expectations. Further market support was provided by a better-than-expected PPI, with wholesale prices only increasing 0.2% versus an estimate of 0.4%. This, in addition to the Philly Fed President Patrick Harker communicated support for the slowing of rate hikes and possibly stopping earlier than what the market anticipates. These comments, along with the previous comments by Brainerd, seem to coincide with the peaking of inflation and an anticipated rapid decline into next year, as is noted by several high-profile market analysts, from Wharton's Jeremy Siegel, Fundstrat's Tom Lee, and Morgan Stanley's Mike Wilson. The continued lower interest rates of the long-term bonds seem to confirm this, as lower long-term rates usually point to the ending of the late cycle and hence the completion of Fed rate hikes. With the U.S. consumer making up 70% of GDP, the market moves from late yesterday to this morning, supporting a monumental shift in the drivers of market movements, specifically with regards to the consumer, pushing aside the inflationary story of the Federal Reserve's attempt to attenuate consumer demand to that of economic fundamentals, thus possibly ending the mantra of bad news is good news. This supports the long-term bearish narrative authored by Morgan Stanley's Mike Wilson of fire and ice, with fire being downward pressures from inflation and the Federal Reserve, and ice being lower earnings and growth, which Wilson states the market has not yet priced in, and will likely cause a retest of the 3,500 level in the first half of next year. This ice narrative seems to coincide with continued inversion of the 3-month and 10-year yield curve. There was a sharp temporary intraday decline caused by a massive Russian strike where 85 missiles were aimed at Ukrainian power infrastructure, with several missiles landing in a Polish village 15 miles from the Ukraine-Polish border, killing 2 civilians. Looking at the chart, it is notable that the S&P 500 price action continues to follow a price channel and continues to challenge the upper boundary of that channel for a third consecutive day. An interesting observation is noted that the 150-day moving average is provided support for the second day in a row. This is reminiscent to the July-August rally, which also followed a price channel with an 8-day mid-rally stall that seemed to find support at the 100-day moving average before resuming its climb to the 200-day moving average. This poses the question if this pattern is re-emerging with the market treading water at the current level supported by the 150-day moving average while it waits for another bullish catalyst before moving higher. The CCI continues to remain in overbought territory, with the MACD noting continued loss of upward momentum. RSI continues to flirt with the 70 level. It is noted that the July-August rally had a similar pattern. However, during the July-August stall, the VIX continued to trend lower. With the current stall, the VIX is noted to be climbing. This rising price volatility may be signaling that the rally is losing upward conviction as more traders opt to exit the rally. It may be prudent to trim profits at these levels or place a trailing stop loss to hedge against a significant downside move. That's it for today. Have a good day.